Thank you everyone for joining us for today's webinar featuring credit futures in your portfolio. My name is Corrine Baynes. I work at R.J. O'Brien in our fixed income group, and joining me on today's call is John Coleman, SVP Managing Director of R.J.'s fixed income group. So today we're going to be talking about an overview of a new trading strategy. This will be a spread trading strategy. Just for a couple of brief comments before we get started, all listeners today will be listen-only mode. We will have a segment at the end of the presentation for question and answers. So if you have any questions throughout the webinar, please type them in your question queue to the right of your webinar screen, and we will do our best to address all questions after today's webinar. As a disclaimer, the risk of loss in trading futures and options is substantial, and each investor and or trader must consider whether this is a suitable investment for their own investment. So to begin today and give you an overview of what we're going to be talking about, we are going to feature a somewhat newer trading contract, the investment grade and high yield credit index futures. These are lower volatility equity index correlated products. Today we're going to teach the basics and give you kind of the outline of what these contracts are and teach the basics of a credit spread trading strategy. So to give you an overview of what these credit contracts are, there's available to trade both the investment grade, the IG, and the high yield, the HY credit index futures. These index futures are based off of a basket of corporate bonds. The investment grade tracks a basket of about 125 corporate bonds. The high yield tracks a basket of 100 corporate bonds. These credit contracts, they're futures contracts, they're cash settled, and they are listed on the ICE exchange, ICE Futures US. They began trading about a year and a half ago, actually a little over 2 years ago. So these are available to trade today. We have brokers at R.J. O'Brien, market strategists at R.J. O'Brien who have traded these contracts previously. They're 5-year instruments. They track the current credit environment for both the investment grade or the high yield environment. In the basket of corporate bonds in the index includes sectors of consumer, energy, financials, industrial, technology, and high volatility. So trading these contracts can give traders the opportunity to gain exposure to the credit environment. Without buying each individual corporate bond within the index, you can gain exposure to the entire basket of index by trading the future. To give you a bit of the contract specs of these IG and HY futures, each contract has a notional value of $100,000. The tick size is 0.01 or equivalent to $10 for price movement. The quoting convention is expressed in index points, for example, 106.75. Both the IG and HY carry a coupon annually. The investment grade has a 1% coupon annually, and the high yield has a 5% coupon annually. These coupons are wrapped up into the actual futures price that cash settles daily. The margin requirements for both of the futures contracts, for the IG, a hedger margin requirement is $600. For a speculator, it's $660. For the high yield, hedger is $1,600, and the speculator is $1,760. Some product benefits of these credit futures contracts include the opportunity for new market participants. A lot of people listening in on the call today, and the reason that we're running this webinar is to give people the opportunity to know about a newer contract that's being traded in the market. There's newer trading strategies that come with new contracts that are being traded. So today, that's what we're talking about, is a new spread trading strategy, which is what we're going to talk about in the second half of today's webinar with John Coleman. These provide correlated equity performance and lower margin requirements than similar contracts such as ETFs. These contracts provide operational efficiency. They're fully supported by existing futures infrastructure. So any other futures contracts you currently are able to trade or do trade with RJO's futures division, these contracts would work in a similar fashion. These contracts have tradability supported by RJO's platforms, including WebOE and RJO Futures Pro if you trade on either of those platforms. And the contracts are CFTC regulated. To give you a bit of a visual graph of the trading performance, these graphs show data from January 2016 until June of 2017, so about 18 months worth of data until the last month. These show the volume and open interest of both the IG and HY contracts. So the graph on the left, both the light and dark blue lines show the trading volume for the investment grade and high yield contracts. Noticing the obvious spikes in the graph in September and March kind of follow suit with other similar futures contracts in the settlement months. These contracts settle semi-annually, so these spikes in trading volume typically would reflect those 2 periods throughout the year when these contracts are settled and rolled into the new on-the-run contract. The graph on the right shows open interest for both the investment grade and high yield contracts to show over the last 18 months what type of open interest has been expressed and traded for both of these contracts. So to begin kind of segmenting into introducing our trading strategy, today we're going to be talking about a trading strategy that uses the credit contracts in addition to the E-mini S&P 500 futures contracts. So looking at these contracts in comparison and side by side and together to kind of show you how they would act similarly, we looking at historical trade analysis and data and price quotes. We found that it would take 10 IG contracts traded to move like 1 E-mini S&P historically on a dollar change basis. And similarly, it would take 2 high yield credit contracts traded to move like 1 E-mini S&P. Comparing similarly the margin requirements, the investment grade margin, like I mentioned earlier, is $660 per contract. The high yield is $1,760 per contract. And the E-mini S&P margin is $4,620 per contract for contracts traded overnight. There is a system in place with RJO that there is reduction for day trading for the E-mini S&P, reduction for the margin requirement. So it is half the margin requirement required to trade if you are day trading these contracts. So if you do not carry the contract overnight, then for the E-mini S&P, only $2,310, so half the margin is required to be posted to trade the contract if you're day trading and not carrying them overnight. This margin reduction is currently not offered for either of the credit contracts, the IG and HY, though there is the potential for this reduction to be included in the future. But for now, this margin reduction for the day trade is just offered for the E-mini S&P. So we're going to segue now a little bit into a little more comparison of the 2 contracts, and then we'll go into showing you guys an example of this spread trading strategy. I'm going to introduce John Coleman to begin speaking. Take it away, John.
Thanks very much, Corrine. Hi, everybody. I'm going to give you a little bit additional background just in how these contracts are used. Since we've never had a credit future trade on the exchange, some people that have been involved in interest rates before, maybe they've traded the TED spread where it's a Eurodollar against a T-bill or a strip of Eurodollars against a Treasury to try to replicate some forms of credit sensitivity. Well, with these contracts, they are entirely isolated credit exposures. Corrine said they're tied to the way that a basket of corporate bonds, high yield or investment grade trade. But instead of having the risk of a 5-year, like a 5-year Treasury or a 5-year swap future, they don't have any duration. They simply trade in relation to the spread. So a yield differential between where a Treasury future or Treasury security would trade and where an investment grade or high yield basket of bonds would trade. And just for those of you that are trying to figure out, well, what's the whole deal with how are these things tied exactly to S&Ps? Generally in the arbitrage community, the layoff for risk in credit is the S&P. Other equity indices have high correlation too. The MSCI Emerging Markets also trades on the ICE, has like a 70% margin offset. The point is if you sit back and you think about it, it's fairly simple. If a company is doing well, its stock does well. In parallel, its cost of credits comes down, and its bonds will tend to outperform. Conversely, a company that does poorly ends up having a higher cost of funds. So the way that this thing effectively operates is people are simply looking at, well, if a basket 100 or 125 in investment grade or high yield companies are all looked at together, they kind of have to behave like the equity market. And as you can see on the bottom of the slide, for those of you that look at the stats a little more closely, the correlation coefficients for IG and HY versus the S&P, these are just simply close to close, are extremely high, 96% and 86% respectively. So that immediately, although that doesn't tell us for the rest of you stats fans, if you were to look at a mean variance hedge ratio for the last 3 months, roughly, HY trades at about a 2.05 MVHR versus the S&P. So quite literally a 2 to 1 or 205 to 100 if you wanted to get a little more precise. That's the ratio that's better, and it's a fairly stable traded ratio. Similarly, as this little graphic illustrates, 2 HYs are roughly akin to 10 IGs, and in fact, if you traded investment grade against high yield, you'd find that there's a very substantial margin offset for 5 IGs versus 2 HYs. And in other applications for these contracts, if you wanted to make your own ETF instead of going out and buy one, if you wanted to buy a $100,000 worth of a high yield ETF with a 5-year duration to it, you'd probably go down and put down literally $100,000, or at equity leverage, perhaps you had other monies that were in there, and you could get a 2 to 1 type leverage on it. Well, kind of looking at this in equivalency, you could buy a 5-year treasury and buy a high yield future, kind of create your own synthetic ETF, and by margin you'd be putting down about 3% of the face. So as opposed to having to put up $50,000 to control 100 grand worth of this ETF, you could build the synthetic and quite literally put down $3,000 to control 100,000. So there are practical applications in terms of what are other funds involved with and how are they using these. A fund will oftentimes, if you're running an ETF or you're running a mutual fund, you have to be prepared for liquidations and when we hit bad markets. And as opposed to going out and trying to sell bonds in a bad market, and oftentimes corporate bonds have a terrible bid-ask. They're not like a treasury where it might be a tick or two. In worst case, oftentimes it's a point or more. So what will happen is the funds are required to carry, or they do carry a large percentage of cash, maybe 3, 5, 7% in cash to be able to meet any redemptions that came. In order to make sure that their beta, their performance on that percentage they're holding in cash acts like a high yield index or acts like an investment grade index, they'll go in and oftentimes use the institutional derivative form of these futures, credit default swap or credit index CDX contract. But the concept is exactly the same. That in order to get this correlation, that's definitely a product that they'd want to use. And from a trader standpoint, for people that are today we're going to look at a strategy that just involves day trading, but for someone that perhaps doesn't want the dollar value volatility of holding S&Ps, but they do want that equity or equity-like exposure, you can scale it back if you can get roughly 50% of the performance of an S&P using a high yield future. Well, that's one way, or you could get 1/10 of the exposure using an IG. It's an alternative that people that are involved maybe in assembling synthetic portfolios, or if you're following trends or whatever your approach is, you can reduce the volatility, in effect kind of carve out your own mini if you wanted to think of it that way. The institutional uses for these products are all over the place for people that follow the agency market. Credit risk transfer bonds that are issued by Fannie and Freddie are the mezzanine tranches of those bonds are highly correlated to HY. Any type of a non-prime mortgage in the event of problems in the market, as a lot of us remember from a decade ago, correlations go to 1 or -1, and typically anything that is high yield sinks catastrophically when there are problems in the market. So there are a lot of different applications for these futures beyond just trading. So today we came and wanted to talk to you and bring at least some type of an explicit strategy. For those people that are deep in pocket, there's a fairly simple approach. Anytime you can look at something with a 96 R squared or an 86 R squared, you could simply sit back and say, okay, when high yield becomes extremely cheap to S&P, I'm going to buy it, and when it becomes rich, I'm going to sell it. You could simply look at data and come up with that. The problem is that ebb and flow of rich, cheap, or outperformance can mean some pretty substantial dollars. So while the products are correlated, it doesn't move like a simple sine wave where things get rich and things get cheap. And from an intraday basis, as a day trader, how do I effectively get involved in some type of a spread and be able to get out at the end of the day with some expectation of making money? And so I'm going to run everybody through a data set, and hopefully this won't be too confusing. There's a lot of moving parts, but we'll do our best to try to simplify it for you. So this sheet that's up on the screen currently, very, very simple. We're looking for a margin efficient day trade. And while we know that these products, the HY and the S&P, are very tightly correlated, a lot of things happen intraday. There's a lot of noise intraday, and one of the unique characteristics, or more unique characteristics, of the credit indices, they tend to trade heaviest in the morning, and that's because a good deal of these products are traded out of London. And when the markets tend to move, the S&P or the high yield future will tend to get rich or cheap during the early portion of the session. I'm saying that as a trader, and there's certainly empirical data for it. I don't have a hard number to give you, but if you'll bear with me, we'll walk through a couple of examples. On the screen, if you look at what would correspond to about row 4, we took an opening level, an opening bid and ask for the HY contract at row 4. You'll see 107 bid at 107 spot 10, and we looked at the identical time where was the S&P, and hypothetically the S&P was 2500 spot 25 for bid ask. And the way that we're going to begin this is very simple exercise. We're just going to monitor the change in P&L from the opening level. And in row 7, hypothetically, the HY market moves down a little bit. And now from the initial 107 bid at 107.10, it's 106.80, 106.90. And if you look over to where columns J and K are, because we're trading these 2-for-1 against the S&P, a loss of, or a movement in the market that resulted in 0.2 change is the equivalent of $200 per contract, or 400 bucks. So from the opening mark to where this first current market on row 7 is, would have been effectively losing 400 bucks on the HY contract. Over that same time, S&P dropped a little bit as well, but not quite as much, from 2,500 to 24.95 and a quarter on the bid side. But basically, where high yield had lost 400 bucks, looking over in columns M and N in row 7, we would have seen the S&P lose 237.50. So at this point, we can continue to take market monitors, market observations, until we get to a point where one of the contracts is outperforming the other by $250, and this is simply on a two HYs by one S&P basis. And in row 9 here, this would be our signal where the S&P now is down 137.5 bucks. High is HY is down 400. So literally the dollar difference or change in the market from the open is about 262 bucks. Once we get to that, is again, since these are mean reverting, you'd expect things, well, the bias would be, well, gosh, if one thing gets rich and the other thing gets cheap and they're correlated, shouldn't we sell what's rich and buy what's cheap? Well, what we'll find intraday is oftentimes if the market gets to the point where there is a big enough distortion where you see a $250 move, the market will come back and give you an opportunity, but as opposed to fading, selling what's rich and buying what's cheap intraday, we prefer to do the opposite and actually go along with buying what is rich and selling what is weaker. And in this example here, we see a pullback and to where the difference, the P&L difference is $100, and that would be the point where we'd initiate the trade. So there are a few very simple rules to this strategy that we're throwing out today. The first one is wait until there's a distortion, a P&L difference between one product and the other of $250 or more. Once it gets there, we're going to wait until it pulls back to within $100 difference. When it does, we're going to enter the trade buying what's been the strongest and selling what's been the cheapest. In this case, it would be buying the S&P, which has been strongest, and selling the HY contracts. After we enter that trade, very, very simple. We're literally going to hold this thing until one of two events occur. Either we get to the close and we're going to take it off, or we get to a point in the day where what was outperforming becomes underperforming by $100 or more. So very, very simple rule set. If we start to weaken up and we reverse and the S&P goes from outperforming to underperforming by $100, we'll simply blow out of the position. Otherwise, we're going to carry it to the end of the day and execute at the end of the day and exit the transaction. The only other rule is we won't enter a position in the final hour of trading. So with that, I'm going to show you some raw data. This is just an example. Thanks, Fred. All right. I went back over just over the 3 weeks of the last 3 weeks of June, and give a few examples here. The first one is the least exciting of all, a day that simply never lets you in. We'll take a look at what the combination of days that let you in and win and lose in just a second. But the format here is fairly simple. The very top of the Excel sheet here is where did we manage to get opening marks for our where was HY on the open, bid and ask, and where was the S&P open on the bid and ask. And once we get those levels, we'll just, again, like the previous example, begin marking to market. What are the gains and what are the losses? And columns D and E show that the bid and the ask change for what's going on with HY in dollar terms, as if we were had two contracts of HY on. And over in columns I and J, it shows you the P&L from that opening mark for the S&P. And again, the first rule is we're going to wait until one of these two products, the HY or the S&P, gets rich by 250 bucks or more. So we're going to scroll down. This kind of crunching of cells together is just my time warp. As we go along through the course of the day, we end up finally seeing that, yes, the market did widen out, and we did end up with a P&L, the difference between where the S&Ps were and where HY was exceeding 250 bucks. And at that point in time, 151 Central, down at row 220, The HY contract was down 160 bucks, and the S&P was down 462. So we got to the point where there was this $250 difference or more, and the obvious HY contract was outperforming. So the second rule is wait till it pulls back to $100 differential, and when it gets back to $100 differential, we're going to buy what's strong, the HY, and we're going to sell what's weak, the S&P. As we scroll through the rest of the day, this is simply an example of a day where it never lets you in. As you can see, from a dollar standpoint, we continue to move out further, and this is one of those things where perhaps if you were not trying to day trade, you would enter with a more simple algorithm than waiting for that $100 to pull back, but that's one of our rules. So in this particular day, there simply was no entry. There was a trigger event. The difference between one became rich to the other by over $250 per unit, but never gave us the pullback to 100. The second day, or now skipping, I guess, to June 16th on the calendar, same thing. We take a look at where the opening market was for the HY, and we take a look at where the opening market was for the S&P. Once we get through that, we begin monitoring the P&Ls, and fairly quickly out of the gates on this day, the S&P, the difference in P&L gets to where we're $200, more than $200 difference. And in the course of this intraday mark, we can see the bid side of HY was down 80 versus S&P down 437. So there's our difference. Now we're waiting for the pullback to 100, and as we follow along and watch those P&Ls, a little bit of time goes by, and in fact we do get to where there is an opportunity to get in. It's pulled back to $100 differential, and we're going to buy what's strong and sell what's weak. In this particular day, the HY was strong. You can see a green box in row 67, cell C67, and what was weak, the S&P at the time, 24, 23.5. So we would simply buy the HY, sell the S&P, and plan on waiting for the end of the day or a point where the S&P becomes the more valuable or becomes the outperformer. As we go along, we see fairly quickly that things do reverse directions. I'm sorry here, and what was the S&P being the weaker of the two, it suddenly turned and become the stronger. That's the initial warning that this is definitely not going the way we want. If that difference gets to $100 in P&L, we're going to blow out of the trade, and as it would work out, unfortunately, on this day, we get hit. What was rich, the S&P becomes now the rich of the two, and takes us out of the trade, and ends up with a loss on the day. So those of you that have trade correlated products before, oftentimes what you're looking at is probably something that looks like half the days where you may not get any entry, half the days where hopefully you take fairly small hits, and half the days where you have fairly large gains. That's three halves. How about half the days where you do nothing, a quarter of the days where you have a small hit, and a quarter of the days where you have a larger gain. And that's kind of what we expected when we went through this. And as a final example, we can't end with a loser. We'll look at what happened on another day where we got in. This on June 21st. Again, same story. Mark to market, get an opening level at the same time for S&Ps and HY. Start tracking the P&Ls, and at some point here we see that the S&P becomes rich. The S&P is up $287.50. HY is unchanged on the day, so S&P is the outperformer. We're now looking for a chance where this pulls back to a $100 difference, and fairly quickly here it does, and that would be our opportunity. We would sell the HY at 107.5 and buy the S&P at 2434.5. Excuse me. This time we sit and again we're waiting. We want to make sure the two don't reverse directions on each other. And as we follow down over the course of the day, the P&L, we don't see any type of a reversal. And in fact, this spread, the rich commodity continues to get richer, and the cheap simply remains the cheaper of the two. So in some effects, trading these type of spreads intraday, these correlated spreads intraday, is kind of like a volatility trade. And what we do, since a correlated product, we always expect to kind of mass around some plus or minus number in terms of P&L. I picked $250, but somebody also was more or less courageous, could change that number for entry. But in this case, we follow it out, execute the trade, and exit the position at the end of the day. We'd end up with a fairly decent winner. But the point here is that there are several different ways to trade this. Normally, as I said at the beginning, when we have a correlated product, if you're somebody that's going to take things home overnight, you're definitely going to be biased towards selling what's rich and buying what's cheap. However, in these intraday stretches, we'll find that just the opposite. That generally speaking, if something starts off rich and it gets substantially rich, what we're calling $250 a unit, that it tends to continue on that direction. And if we're to take a look at these last 3 weeks or 3 recent weeks of trading, and kind of push it into a grid and see what we got to do. Well, roughly speaking, we didn't get into any trade for half the days that are out there. We did have a position at some point during the day, all but 3 of the days where it says signal, all but 3 of the days, we did manage to get to where one commodity, what HY or S&P, was rich to the other by $250 in P&L. And if we look over the profits and losses, we have a kind of what we had hoped for. There's one larger expected gain, one profit, one gain and loss that's kind of middle of the road, and then a couple of choppy small gains, small losses. But the idea on a strategy, an intraday strategy like this, is I'm sure many of you know, if you're trying to get out of something the same day that you get into it, you pretty much have to find a position that allows you to get into. If you get into a winner, you're going to run with it. You're pretty much going to carry it to the end of the day, and that's what this strategy provides. There are plenty of ways that you can take a look at this data and come up with variations on this. It's not meant to be a single answer, the holy grail, or anything like that. But what it is it demonstrates that when you have a few commodities that are very well correlated, that you should be able to trade one versus the other. And if you can do it advantageously in a spread, the difference is the guys and gals that are out there that make the markets in these products day in and day out, they're there all the time. You have the opportunity to kind of wait for some event to happen in certain conditions to be met. And if you're selective about where you enter these spread relationships, you can put yourself in position to get on the right side of a market that'll run favorably for you. And that's kind of the end of what we had to do with the trading today. We're definitely going to hope that some of you had some questions, and I'm going to switch positions here with Corrine so she can answer the question and answer for it.
Thank you, John. I hope that was educational for all of you on the line. Let me bring our PowerPoint back up. So we've seen a couple of questions come in throughout the webinar. The first question I can address was submitted at the beginning. People are wondering where access to the recorded version of this webinar can be found. For all those who joined us today and those, if you know anybody that was intending to join us but when I was unable to log in, we'll be emailing a copy of the recording to all of you who joined us today and both for those who were unable to join us. So check your emails for a copy of the recording within the next day or two after this webinar. Another question came in about copies of the presentation data.
Yes, and same way if you contact your RGO futures market strategist, they will have access to the identical spreadsheets and the 3 weeks of data that we went over 3 brief days. But if you'd like to take a look at the intraday data and perhaps ferret out something for yourself, your futures market strategist will be happy to send that along to you as well. See other questions up there, Corrine.
Let me take a look. Another question was asked about people that are currently trading these credit futures. John, would you have an answer for that?
Sure, I kind of touched on it. In the groups that are trading through us, the largest of the large hedge funds still that are trading credit through the CDX market tend to trade in literally billion-dollar increments or larger. We haven't really seen them enter into the future space. Hopefully they will bring some of that over our way, because not every trade has to be $1 billion. But I would say we have most of the general profile of somebody that's using it is a hedge fund that is under $1 billion in management right now. We've also seen some correlated hedge trades. I mentioned something about credit risk transfer. We've seen people trade the investment grade product at a certain spread and with some other conditions against jumbo mortgages. So definitely the user group is diverse, as it always is with futures. Unlike I think the user group for the underlying CDX future over-the-counter products. Anything else up there that we need to get?
We'll wait a few minutes for any other questions to come in.
I see a question up there asking about RGO and real-time data links. I am not our data expert by any stretch, so I would definitely, whoever had the question, do we have an RTD access or direct API into spreadsheets or along those lines? I don't know what we offer, and I don't know what the ICE offers in regards to these products as well. But we'll do our best to get you an answer for that, and to the person that sent it out, look for that in your email when we can give you a better response.
All right, let me check if there's any other questions.
Go ahead, Chris.
I just saw another question come in. Why trade the future instead of an ETF for the CDX indices, John?
Sure. So if we take a look at the ETFs, and there are, in the credit space, there are 2 that are very popular. There's one called LQD and another one that's called HYG. LQD would be the investment grade, and HYG would be the high yield. I mentioned a little bit, one of the problems that comes along with trading those ETFs is you get the full bond duration in addition to the credit exposure. So if you go out and you simply buy an ETF, you get whatever the manager's decision was. If they want to own 10 years generally, or they want to own 30 years, or they want to own 5 years, you're going to get whatever that portfolio composite duration looks like. For somebody that is in the futures market, you can pick your own. You can go anywhere from 0 duration and just take the spread exposure. That's a very big deal too, because if you, Corrine mentioned in the specifications of the contract, if you buy or hold an investment grade futures contract, it accrues excuse me. It accrues at 1% per annum. So the ability to sit on top of that is kind of akin to a dividend. If you held 3 of them, you would, ultimately you're going to receive $1,000 per contract on a $100,000 basis per year. In the case of the high yield, where it's 5 points, even larger. So that I made a passing comment that if you wanted to construct your own ETF, that seems to make a lot of sense to me. Why would I pay somebody a management fee, and why would I get at best 2-to-1 leverage when I can go out and get the same responsiveness? I can pick my point on the yield curve. If I want it off the 2-year, I can buy a 2-year and I can add as much yield through IG or HY as I want, depending on what my risk appetite is. So I would say the ETF, yeah, that's if you want to pay the rack rate, the full price for everything, and pay a manager to manage, and you get whatever it is they want. That the ETF provides that. There's a fairly large negative to holding ETFs too that doesn't get talked about enough, and it has to do with negative selection. When you hit a market that's terrible, and there was a rough stretch in the credit market, and obviously in the equity market as well, in January and February of 2016, credit spreads blew out. S&P got whacked pretty good. The problem for the ETFs during that period is when you hit a market where things are very dicey, the bid level for corporate bonds becomes fairly atrocious. It's I said you can have bonds that literally have points between the bid and the ask, and if you're running an ETF or any fund and you have to get out of bonds in a bad market, you're forced to sell the best bonds that you have in inventory because there's simply no bid for any of your crummy bonds. So what ends up happening, you blow out of your best bonds, you sell them at horrific prices, and that leaves the people that are still in the ETF holding the worst of the worst and having taken the worst hit on the liquidation of the bonds, basically just to pay the people that want it out of the fund. So anybody that has the ability to use futures and kind of recraft their own ETF, you're doing yourself a huge favor because you're getting rid of that negative selection bias that goes along with ETFs. You're getting rid of a management fee, and you're getting to largely pick the duration that you want if there's any. So that's a good question with a very long-tailed answer on it. But what you see if you look at a hedge fund's not going to buy an ETF. They're going to go out and build what they want themselves. Those of you that have access, and obviously do if you're on this call, to the futures market, build it, don't buy it. You can get at a much better leverage and better liquidity, a product exactly that matches what you want. So I guess that would be my answer there.
All right. I guess we'll have time for about 2 more questions. I do see a question in here about ICE data feed costs.
Again, I'm gonna have to plead ignorant on that. We do your RGO futures market strategist will certainly be able to get a hold of any of the cost requirements that are involved in for ICE data feeds or any data feeds, and I'm sorry, I'm not prepared to answer that.
All right, and we'll address our last question. John, can you talk about the liquidity of the futures versus OTC and ETF contracts?
Sure. Today the OTC market is more liquid. So if we were to pull up the IG future in the over-the-counter market, we would probably see that it is 2/10 between the bid and the ask. You also, if you were to look at the futures, you're probably looking at 3/10. Why is there a difference, and how can that exist? Well, first of all, if you are trading the over-the-counter product, as I mentioned, there's almost no chance you're trading it in units under 100 million, and in most cases, you're probably trading it in units over 1 billion. So accessibility to the market is part of it. Quite frankly, if you're a market maker, if you can get a 1 or 2 tick edge on a $1 billion in notional, that's pretty substantial. For the people that step up and make the markets in HY and IG, they do an excellent job of being there day in and day out through When we started trading the ultra 10-year future, it wasn't that hot. And certainly, if you go back to days before that and other futures contracts that are out there. So the answer is, if you happen to be running a $300 or $400 billion hedge fund and you have access to the best of capital markets and derivative space, you will get best execution using OTC. For the rest of us that don't have a few billion to trade in a single clip, the futures are awesome. Let's compare that then. So let's talk about the ETF. It is not fair to compare IG futures and HY futures to LQD and HYG that I mentioned. And the reason is, again, those have physical duration. If you have to go out and hedge that duration away to get to the spread risk, there are futures, there are ETFs that are the hedged versions. HYGH is one. If you were to take a look at the liquidity in that contract or in that ETF, it is poor. It is to try to go out if you said I just want to trade $1 million. Well, gosh, for us that's 10 futures contracts. No problem. You want to trade $1 million of HYGH, the hedged version. I'm not sure where you can get that done. You could take a look and check the block markets. That would probably be the biggest trade that occurred in there since they started trading that ETF. So I think there are 3 different markets, and they do fit 3 different profiles. If you're a simple equity investor and you're going to pay a premium for passive management, and ETFs is an excellent alternative. For somebody that has the trading sophistication to go out and build what they want instead of overpaid for it, I would absolutely do these trades in futures. Build your own ETF. If you have that hundreds of billions of dollars in a fund, you can make these CDX transactions over the counter and do them even more narrowly. But my suspicion is we haven't had, since listing these contracts, we haven't had a down cycle in credit. Normally, credit breaks before interest rates due to a government intervention and several other things. We just simply haven't seen a credit crack. So it'll be, and obviously any of you that trade equities know we haven't seen much of an equity crack either. So we'll see. My belief is that there are quite a few people that will have interest in using these futures when there's more volatility in the credit market itself, as opposed to today where it's been very, very stable for protracted periods of time. But that's kind of an add-on. So hopefully that answers your question about liquidity in the over-the-counter market versus the futures market versus the equivalent hedged ETFs or zero-duration ETFs.
Thank you, John. And thank you, everybody, for joining us today. Like I mentioned, you'll be receiving a copy of the recording of this webinar. And please direct any future questions to your RJO Futures Market Strategist or send an email to the link provided on the screen. Thank you, everybody.